Now, lads and ladies, into the meat and potatoes, the good stuff, the important stuff, the interesting stuff. We have candlesticks. You look at a price chart. I can't click off this now because I'm at the button this up and it's going to disappear every hard. I should look fucking fun. Now, when you look at a chart, you have a few different options of what chart you want to look at. This is the candlestick chart, normal chart everybody uses. Then you have a line chart. A line chart is if you want to look for what price is doing without the noise. A line chart just only takes into account candle closures. So if you get a big, massive, dirty wick, it's not the line chart. It's not going to show up. It's just going to show up the candle closures. But the main one that we use is just obviously a candlesticks. We have hollow candles. Few different ones you can use. Not that one though. If we go back to candlesticks for a moment, up here you'll see the time frame that we're trading on. Currently, we are on a 4-hour time frame. So that means that each and every single one of these candles that's on this screen, this one and this one and this one, although they're all different sizes, different shapes, different wicks, different opens and closes, they all took 4 hours to print. So if you jump down to a 1 hour, it means for every one of these candles, there's going to be 4 1-hour candles. So you're going to get a better read of what price is actually doing as you work your way down 15 minutes. Every candle on this screen now took 15 minutes to print. And then as you go down the way, self-explanatory, daily, weekly, monthly, and like that. If you want to get a gauge of what price is doing long term, you can look at the patterns. Oh, no, not the patterns. You can look at the chart on a higher time frame. But that's a different video altogether. So if we go back, if we can find my drawings over here, you know, bang, look at that, bang on the money. Bang on the money. Now, we have our candlesticks here. So we have two types of candlesticks. You have a bullish and you have a bearish candlestick. You have a bullish is going up, is always going to be a green candle. You can change this as well, go into settings and do whatever you like, symbol, boom, colors, whatever have you, whatever tickles your fancy. Design it to whatever way you want, whatever way you can understand it the most. But you have two candles. You have a bullish candle and you have a bearish candle. Your bullish is obviously a green candle and your bearish is obviously your red candle. So when you're looking at the candles, they print differently. Every candle has a high and every candle has a low. Every candle has an open and every candle has a close. Now, if we go bang, start with the bullish. Do I have that? Now, bullish candles always open low and close high. So they'll open low and they will close high, which is fairly self-explanatory. Like if it's gonna be going up, it's gonna open at this level and then close up if it's a bullish candle, and then vice versa if it's bearish. Whereas is that gonna let me drag it? That's stupid. With a bearish candle, we open high. No. Slow technology, man. Open high, and then we close low. So this is called the anatomy of a candlestick. The anatomy of a bullish candlestick is we open low, close high, and the wicks represent the story. The wicks represent what price managed to reach but didn't manage to close. So, for example, we get this clear here first. Bang, bang. This wick is going to be our high. This is going to be our high. Now, with a bullish candlestick, what will happen is we'll open low. So with this candle, we get rid of these now, if you understand that. Now, with a bullish candle, it will start like this, and then what it will do is it will come down the way. So for a portion of time, this is actually going to be a red candle. Why? Because before the candle closed, it was technically, to make that wick, it would have had to be a red candle. So it can't come down, it can't open high, come down and still be a green candle, because that's the anatomy of a bearish candlestick. So for one point on a 4 hour time frame, let's say this candle came down and it was a bearish candle. So if we swap that back over now to our green candle, what price would have done is it would have came down, turned red for a minute, established this low, came back up, broke past its opening price, which is when it would have turned back to a green candle, and then came all the way up, created this high, and then came back down, and then closed at this level. So in the last 4 hours, for example, price opened, came down, was bearish for a short amount of time, and then flipped back bullish. So the wick represents where price got to, but never closed. Same thing again on a bearish candle, same concept. So if we move this, bang, bang, say this is a bearish candle would have had to open high, and then for a portion of time it would have been, now it doesn't mean that I've done it straight away. It could have came all the way down, established this, came back up, then made this, and then came back down. Do you know what I mean? That's what goes on the smaller time frame. But on a larger time frame, this is what price done. It opened, it came up the way where it was then a green candle for a short period of time. So then your green candle established this high, the wick high, but we failed to close at that level. In other words, buyers couldn't hold that level, sellers took control. So then we start working back the way, and then as we start working back the way down, we got past our entry price, past the entry point at which the candle opened, which we know is a bearish candle, so it's going to open high and close low. And then we came down, 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 established this wick, and then wherever, close wherever you want. And when we're looking for confirmations, we always want to look for a candle close. So if you're looking for an entry on a fair value gap, you want to look for, if a candle closes above that fair value gap, but then you're going to say, right, well, that fair value gap probably isn't going to be what's the word I'm looking for? Probably isn't going to be accurate anymore. Like, we're not going to use that anymore because you're getting a candle closure outside of that fair value gap. Do you know what I mean? Whereas if you get a wick out of that fair value gap and then pushes drastically back into the fair value gap, well, then you wouldn't take that as an inversion fair value gap. Why? Because you just wicked over. You never got a candle body closure beneath or above or whatever way you may be trading above that zone. And we look at the course now and break down everything a million times easier. Open high, it breaks down. The anatomy of a candlestick is that a bullish candlestick's open, low, high, close. OLHC. It opens low, it closes high. Same thing with a bearish. It opens high, closes low, and then the highest price is what the wick reached it. And the wick tells a story of what price has done. Think of it like that. And a big, massive wick. If you see a big, I might have an example up here. If you see a big, massive wick, it shows, or like say something like this, it might show like indecision in the market because the buyers aren't in control because we couldn't sustain this price, but the sellers aren't in control because they couldn't sustain this price. So we kind of have to meet in the middle. At times like that, it's uncertainty in the markets. I could just stay away, let the chart play out, give me a bit more data, a bit more confirmations, and then you can place a trade. Don't just trade off a candlesticks either. It's not how it works. You can't just, some people would say, oh, I'm going to look now, happy days now, I'm after finding this bullish flag patterns, just going to dive on the charts now and find a load of bullish flag patterns now, and I'm just going to be sucking diesel then. It's not how it works. You have to use what you know about candlesticks to assist you, but not to an only confluence stutter. So we see here now for this candlestick price opened here, and for a while this candle would have been a bearish candle, bearish. And then what happened? We flipped the script. So it was a bearish candle. This is a 4-hour candle now. So it was a bearish candle. We came down, we established the low with a candle, we came back up past the price at which the candle opened and continued to go up, create the high, come back down and close. See this candlestick here? That was what, 5th of February 2026. Right? If we scale down to a smaller time frame, because this is a 4-hour chart, each candle is worth 4 hours. If we drop now to a 1 hour, there's going to be 4 of those 1 hour candles within this big candle here. So if we just track this now, 5th of February 26, 11 o'clock, bang, 5th of February, yeah, there you go. So although on the 4 hour, this candle is just one big wick, we have two bigger candles here. We have a big red candle, and then we have a big green candle. If you drop down even again, we still have this wick. So let's see now, drop down to 15 minutes. So 15 minutes are going to be 4 candles per hourly, but there is an hourly, gentlemen. I hope you're all understanding now, sticking with me. So we can see here now, there's just a lot more data, there's a lot more information on the chart. So it's important to understand why the candlesticks are important. Higher time frame holds higher power. Keep that, keep that in your mind. If you see, say for example, a confirmation would be like a fair value gap on a 1 minute time frame. Right, but if you see it on a daily time frame, it's going to be much more influential, if you will, much more important. Why? Because it took 3 days, for minimum 3 days, for that fair value gap to be created on a daily time frame, where on a minute it would have only taken 3 minutes. So you can kind of see that the higher time frame holds higher power, and do your own back testing on it. Look, see how price reacts to daily time frame fair value gaps, and then see how price reacts to minute time frame fair value gaps. You'll see you get a lot of inversions on a 1 minute time frame, and you won't really get, well, you will of course, but you won't get as many inversions on a daily or a 4 hour or higher time frame. Excuse me. How's that everything we have? That's it. Here's a quote actually I found. Coming across a lot of these quotes, Instagram, I'm telling you now. Spopper. Right. Alright. Wait, we can get rid of this. Again, I'll leave the course details below. May as well sign up for it. It's free, look, you're not missing out on anything. And don't even do this to me. Fine. That didn't work. Yeah, that didn't work. With trading, the goal isn't to be right. The goal is to make the best trades. Focus on the execution, ignore the noise, and let the math do the heavy lifting. If you followed your plan today, you've already won. Trade your process, and you'll see, and I'll see you on the charts. Trade your process, and I'll see you on the charts. You may as well just leave it at that. Leave it at that. Next video is, we'll have to find out. Leave you with that quote. Remember it. Do your study. Get your notes out. Look through the course. Understand candlesticks. That's what you're trading. You're trading the patterns. You're trading the movements. You're trading whatever. As soon as you look at a chart, you're going to see a candlestick. So it's important to understand what it is, what it represents, and how to read it. So look, we'll see you on the next video.